Okay, good morning, everyone, and you're very welcome to this morning's Coffee Microcaps Morning Meeting. My name is Mark Tobin. For anybody who is joining us here for the first time this morning, you're all very welcome. I've just got a couple of quick intro slides, and we are then going to get straight into it with the first of our three presenters here this morning. I'd like to give a mention to RAS Researchers as Service, who you will know as our virtual event sponsor here at Coffee Microcaps. If you are looking for some institutional grade research on some small and microcap companies, please do check out their website. Quick compliance and disclaimer slide, and a very welcome to anybody from ASIC joining us this morning. For anybody who is joining us for the first time this morning, companies we tend to have on here are capped under 300 million. That's our definition of a microcap. Are in revenue and approaching cash flow break even, or as we will see this morning, where some of our companies are indeed already profitable. We tend not to have companies from the resources and biotech sector on here, and what I like to call industrial microcaps, which kind of encompasses everything else from healthcare to financial services, technology, hardcore industrial businesses, kind of anything that kind of falls out of those aforementioned sectors. Structured this morning's webinar, we are going to have three ASX microcap companies presenting this morning, 30 minutes each, which we'll break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than in the chat function. It just makes it easier for me to moderate them to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials. Twitter is our main one. YouTube, as I said, for the recording of this event, and indeed all our other events. We've got like well over 100 events on there, probably in excess of 250 microcap companies over the years on their LinkedIn. And I do write a free monthly newsletter that goes out on the Substack platform, and our main newsletter went out just yesterday. First up this morning, we're going to have Clever Culture Systems with Brent Barnes. After that, then we are going to be joined at 10:30 by Billy Tucker from Beonic. And then finally, we're going to wrap up with Adam Bennett and Miles Drury coming back to give us an update on Plenti Group. But that is enough from me. So I'm going to stop sharing my screen and hand you over to Brent. Brent, if you want to just pull up your deck. Yeah, I can see the cover slide of your presentation now, Brent.
Perfect.
You are ready to go.
Thanks, Mark, and welcome everyone. So Clever Culture Systems is the name of the company, ticker code CC5. You may have heard us previously around this kind of culture plate workflow and AI-powered microbiology under the code of LBT. We changed our name to Clever Culture Systems back in November of last year, which basically just aligned our commercial name with our investor name and just aligned communication. So one of the same company. Normal disclaimers do apply. Huge amount of talk obviously going on at the moment with respect to the US and a whole bunch of different areas. But I think one of the exciting parts of all of this attention is the space that we operate in, and that's pharmaceutical manufacturing. So these are our customers, if you like. And I encourage anyone just to do a Google search on terms such as US pharmaceutical manufacturing investment or improvement. And any Google search will kind of list a myriad of news articles that are outlining a huge amount, billions of dollars of investment into ramping up, modernizing, building new manufacturing facilities for pharmaceutical products that are US based. And this is a trend that we saw before the tariffs, I should say, where we've got this market dynamic of a growing industry needing to manufacture more and more drugs and infrastructure needing to kind of catch up to that. Also having pricing pressures around drugs being cheaper while maintaining quality of these results and having ultimately safe and effective drugs. So when you think about Clever Culture Systems, when you think about the market we operate in a really attractive market, a growing market, where our customers are pharmaceutical manufacturing companies. And I think importantly in that light, thinking about our customers, we're not talking about early stage drug development companies. We're talking about companies who have a biological product that's already gone through the regulatory approvals. It's already been shown to be safe and effective for clinical usage. We're talking about how do these companies manufacture these drugs in a high throughput way where they can get out and sell these products on a global basis. And so it means that there's a very kind of predictable and steady go forward opportunity with respect to these manufacturing of the drugs. And it's been a real transitional year for Clever Culture Systems over the last 18 months, underpinned by a couple of blue chip customers. And, I think maybe it's a bit of an oxymoron, but we're one of the few biotech companies or life science companies that are actually on a path and will look towards moving into a profitability year in FY25 and obviously looking beyond that. So figure, kind of beachhead customers here, AstraZeneca, Bristol Myers Squibb, pretty global giants. They're the top biggest pharmaceutical customers, at least by revenue. And when we launched this product about a year ago, we've now subsequently sold 13 of our APAS instruments since that product launch. And AstraZeneca has certainly been our cornerstone customer, the earliest adopter. They've now purchased 9 instruments as part of a standardization process for environmental monitoring of microbial control, and I'll talk about this later on. But effectively, that they've chosen our technology as an optimization or replacement for the current manual process that occurs in these microbiology laboratories that are performing environmental monitoring. All of that's kind of resulted, at least in a half year maiden profit, really driven by product sales. We've got an install base now of 27 instruments, and that represents a bit over $500,000 of recurring revenue. I should say that's high margin recurring revenue, which is really comprised of software licensing and service licensing for the hardware. From a cash position, we have cash and current receivables of approximately $5.8 million. So we're well funded with no plans or looking towards raising any capital. And I think importantly around that kind of corporate and the outlook is thinking about our pipeline. We announced in our quarterly recently that it's great to have been able to move towards this profitability year, but it's really about looking towards the future. And while we've executed on our transition into profitability in FY25, how do we think about 26, 27 beyond? Well, we're looking really strong in that regard. Over 40 qualified customers that we're talking with, all at different stages of maturity. I'll talk about how we're really laser focused on really the top largest manufacturing customers, at least by revenue. And we think a pipeline as it sits now represents around $75 million of upfront sales opportunity and about $15 million in recurring annual revenue. So, really kind of bullish around what we've been able to achieve in this first 12 months of launch, but also thinking about future years and sustainingly growing this business into a profitable company. So when I say pharmaceutical manufacturing, that's a big umbrella, kind of narrowing down on what it is that we're looking to help optimize and improve for our customers. It's something called environmental monitoring. It's a critical process that happens in every manufacturing facility for sterile drugs globally. It's designed and required to really measure the quality and the safety of that manufacturing process, and ensuring that state of manufacturing is in a state of control. And that's really important. So there's a whole bunch of air conditioning and a whole bunch of different systems that go into making that environment clean in a clean room. And part of measuring on an ongoing basis is applying culture plates into that environment, rotating it on a constant basis. So it's a constant state of measurement and then a constant state of reading these plates, looking at what's growing and trending and managing that workflow to make sure that those drugs are manufactured in a sterile environment with no contamination that would exist during the batch of that manufacturing process. And look, I guess the implication of getting it wrong is fairly significant. And so the picture you see here is a picture of a culture plate, and that plate's been in a clean room, and the different little circles on there are different forms of bacteria growing on the plate. There's a mold that you can see about 5 o'clock on the plate. But what happens is that these plates come out of the clean room, they're incubated, and then you have microbiologists that need to count those colonies that are growing on the plate. They have to identify any mold that occurs specifically, and that information is passed into the laboratory system, and it's about trending, right? Trending the environment for that clean room. And I think at the extreme case, right? In the extreme case of an incorrect result, the worst case scenario is an adverse event for a patient. So perhaps it's a drug that goes into the eye and might cause something like eye loss. In the worst case scenario, it could cause death. So, the critical part of making sure drugs are safe and effective for use is making sure that they have a manufacturing process that is in control. And part of making sure it's in control is this environmental monitoring application. I think kind of stepping back from that, a voluntary product recall, if you identified an issue with a batch of drugs that's already been released into the market, well, then that would need to be recalled as part of a voluntary recall. And the regulators, the US FDA, the other global regulators, will come into our customers' manufacturing facilities, and they'll look at a range of things, including their environmental monitoring program. They'll want to see plates, they'll want to understand process, they'll want to look at trends, and all of those things may cause quality events. And so really the point here is that quality, traceability of those results are paramount and critical, and any way that customers can look to automate those processes is really seen as an opportunity for them to mitigate risk. And that's exactly what we have done. And so with that context in mind, what we've done is we've spent about 10 years developing an instrument and an algorithm that's now fully validated for this application of environmental monitoring in clean rooms. So the picture of the instrument is on the left hand of the screen. Really the core product and what sets this product apart from anything else that exists, and we're the only one as an endpoint reader, is this artificial intelligence application that we've been able to train algorithms looking at hundreds of thousands of plates. And what we do really, really well is identify colonies on the plate, and we do that in a way that we call this non-inferior, or at least equivalent to the current standard process, which requires 2 microbiologists looking at all of these thousands of plates, millions of plates that go through these clean rooms on a global basis every single year. And so, it's patent protected. The imaging station, the image analysis application, the calibration tools, the lighting is completely patent protected, including the algorithm itself. The way that the system runs is pretty easy. So it's a plug and play type of system, and it's got a high degree of walk away time. So the customers will come in, they'll load the system on the left hand side, they'll start a session using the user interface, and then they walk away. And the system will run independently for about an hour, and it will move plates from the left hand side of that instrument through the imaging station. In the middle, a photo is taken of the plate top and bottom. An algorithm interprets what's growing on the plate, and a decision is made real time. And based on the decision, we'll move that plate to the output part of the instrument. And so you've got this physical sorting of plates, those plates with growth, those plates with no growth, and obviously those results are digitally interfaced to the laboratory information management system. So the value proposition here is that we're improving the quality of the current process, and we do that by having a permanent record of that image. The second thing we do is that we improve the traceability of that result because we have a digital interface to the laboratory system, no manual intervention. And then the third thing is that we do it more efficiently, so about 3 times faster than that of the current standard process. Here's a few pictures of some plates. So the top image is the same as the bottom image. The only difference here is you've got these bounding boxes on the bottom image, and that's really showing our AI algorithm successfully identifying the various colonies that are growing on these plates. And some interesting things that you can see here. So you can see some artifacts on the plates that can really challenge AI platforms. And so the label being one of those, you've got some dot matrix printed wording on the bottom of some of these plates, and you've got these grid patterns of injection molding, which is aimed to kind of help count colonies. And so all of these artifacts, that interferences that can really cause challenges from an AI model perspective. And we've been able to overcome those challenges through an extensive training program, an extensive validation program. And so you'll see in these examples, those bounding boxes successfully being around those colonies under the labels, under the dot matrix, and across some of these injection molding parameters, particularly at the side of the plate, which can cause some interference with the injection molding. So, it's a machine learning to transform this colony detection on agar plates. And it's a big market opportunity. So we've kind of calculated about nearly a $3 billion total addressable market. And what we're talking about here is biologic production in these manufacturing facilities. And it is this environmental monitoring is something that's mandated. It has to be done. It's not optional, and it happens in every single lab all around the world. And it's a critical process that is part of releasing safe and effective drugs for clinical usage. From a revenue model perspective, we have a combination of upfront revenue, that being the instrument, so about 50% of the $1 million of revenue per instrument sale is received up front, so about $500,000 for the instrument. And then we have a combination of different services that we offer, as well as the software that's the annual recurring revenue. So there's a license fee for the AI module itself. There's software and hardware support services that we provide. And what we've found is that when we implement and we support our customers through this validation activity, they typically go through a secondary validation process that we charge for that effort as well. And we support our customers along that journey from validation through to transitioning that the APAS instrument into routine operation within their manufacturing facilities. So the gross margin on the software licenses are super high because we've already kind of spent the money developing it. So you've got this combination of an upfront capex, but also an important recurring revenue component of our revenue model. With respect to our go-to-market, I call it kind of a land and expand strategy, or you could call it an enterprise customer strategy, where really we're kind of focused on really the largest pharmaceutical manufacturing companies by revenue. So these are customers who have multiple locations around the world. They've got a very sophisticated process of monitoring all of their global manufacturing environments. And we typically see that all of these customers have a centralized center of excellence around microbiology, a center of excellence around environmental monitoring, and they're looking at the trending, they're looking at potential audits, they're looking at adverse events, and they're looking at new technologies that may aim to reduce risk, to optimize workflow, improve quality, and obviously improve efficiency. And so that's a really important characteristic of our sales model, because our approach, therefore, is not to hire huge amounts of salespeople and needing to build this highly expensive sales organization and have people in every part of the world. We've got a very nimble and small sales organization. We have coverage in Europe, we have coverage here in Australasia, and coverage in the US. But we don't need to have lots of foot soldiers on the ground. What we need is to get into these big customers. We need to find that centralized center of excellence group. And then what we've found is that we're working in a very collaborative way and a very isolated way to help customers understand the value proposition, work through an evaluation process, and then move through to implementation. And so that example, if you like, of AstraZeneca being a great case study of this land and expand or enterprise customer. AstraZeneca are our cornerstone customer. They've now purchased 9 instruments. We'll install all of those 9. Most of those 9 have already been installed, but we'll finish all of those installations in the FY25 year. And it's across multiple manufacturing locations, and a majority of that value is received up front. I think the other important characteristic of AstraZeneca is that they've been fantastic advocates for the technology, and they've presented at a number of conferences explaining why they invested in APAS independence, what the problem is that they were trying to solve, and looking at the value proposition that the technology brings across their multiple manufacturing sites globally. So we see this being a really important and powerful case study for other pharmaceutical manufacturing customers to follow suit. And we have seen that. So Bristol Myers Squibb, another, probably top 10 biggest pharma company by revenue, their Center of Excellence facility is based in the US. We kind of installed one there, and after a couple of months, they bought that instrument, and after about 6 months, they've bought another instrument at a different facility. And so we kind of see this model of working with this centralized group, expanding throughout the network, being one that's a very effective way to kind of help our customers standardize a workflow that already is very standardized across their global manufacturing organizations. So kind of a bit of detail here, stepping into, well, what does it look like within a manufacturing environment? So on the far left, you've got culture plates. There's a couple of different configuration of culture plates. You've got a 90 millimeter settle plate, and that literally is a plate that goes into the clean room. The lid is taken off and the environment settles onto the plate, and it stays there for 4 hours. It's then rotated every 4 hours and a new one kind of goes in. You've got a contact plate, which is used for dabbing surfaces, like the picture that you can see on the screen. It dabs personnel clothing, fingerprints, and that's another application. So you've got a variety of, if you like, culture plates that's used in different areas of the clean room. It then goes into an incubator, which is just like a fridge, really, for 5 days. And what happens is that during that 5-day period, you're looking for bacterial or mold or fungal growth to occur on the plate. And obviously, that type of growth doesn't occur very frequently, but you want to make sure you identify that. And then the final part, it's really a critical part of that workflow, is reading and reporting of those results. And so those plates and that's currently done manually, and it's done by 2 people. And the reason 2 people or 2 microbiologists read all of these plates is because they don't always get it correct. There's either a transcription error in kind of keying the information into the laboratory information management system, or perhaps not successfully identifying that colony growth that occurs on the plate. But it's an important reporting tool to measure how the environment is being operated and within control. And so kind of putting this now, the APAS 2B process in, it really improves that traceability, quality, and efficiency of the result. And it does it, in a way that's far more effective than that of the current process. There's a huge amount of validation work that's gone into demonstrating APAS is non-inferior to the kind of standard workflow. And when you think about kind of, the positivity rate, over 99% of plates kind of go through the workflow with nothing growing. And so there's a huge amount of cost and labor effort for manually reviewing all these plates, where most of the time those plates don't have any growth. But that result is super, super important in order to release drugs that are safe and effective for use. And so kind of visualizing, this is a bit of a repeat of that image of a culture plate that I showed earlier on. This is the power of an AI application. So we've got all of these plates now being imaged. Today, they're not imaged at all. They're just read by 2 people. So I might have got it right. My second reader might have got it wrong. Those results go in. In the end, there's no permanent record. It's just what we've said and reported. Where now you're improving that quality. We've got a permanent record through a web user interface, and you've got this AI platform that correctly and accurately counts all of the colonies on the plate. We actually use this in some of the trade shows that we present at with customers, and part of that is showing the image and saying, well, how many colonies do you see on the plate? And we have a bit of a game, a bit of an exercise. And obviously what you would expect and what we find is that we see differences in the accuracy and variability in the way that these plates and these colonies are being counted. And those results are really important. With an AI application, we get a repeatable result. We put this plate through the APAS system, and you're going to get the same result every single time. If you were to give this plate to 5 different microbiologists, you are likely going to get 5 different results. And so this is where, it's very much a game changer when we think about quality, traceability, and efficiency of a current manual process in a highly, highly regulated environment. We don't have a lot of competition, so we are the only endpoint culture plate reader that exists on the market. There are two competitors that have an incubator and a reader in one big instrument, right? So if you remember that workflow before, you're kind of applying these plates within the clean room, then the lid's put on and they're put into an incubator, which is a fridge, and it stays there for 5 days. So these systems have an incubator, so that big fridge, and then they've got an imaging station built in together. They're significantly more expensive than what we have. And I think the challenges that you've got here is more around capacity. And so, this middle one here, the Growth Direct system, the incubation capacity is 660 plates. Well, a 5-day incubation, so if you divide 660 by 5, it means that the capacity per day is 132 plates per day coming out of the manufacturing environment that will go into this one system. And when we think about the example of AstraZeneca, at one of their facilities, they have 1,000 plates that need to be loaded into an incubator on a daily basis. And this is where we have a complete game changer technology, because you would need 1 or 2 of our instruments versus probably 7 or 8 of the instruments. And so you're talking about literally millions of dollars of difference when you kind of compare the two technologies. So a huge competitive advantage, but nevertheless, there's competitors that exist within the marketplace. Board of management, obviously every company's got to say everyone's experience, but I think one thing that sets us apart is that we're very much invested in the longevity and the outlook of the company as shareholders. So collectively, board of management own around 23% of the shareholding. We have a range of different experiences, and quite competent in this space. I think kind of looking at our outlook, I think we're at the moment really laser focused in finalising FY25, moving this company into a transitional year, moving into profitability. Not many biotech companies can make that claim to fame. We are really looking to expand our pipeline and kind of replicate what we've done, at least with AstraZeneca being one example, building that out through Bristol Myers Squibb. I gave the example of kind of where our pipeline is at the moment in terms of those qualified leads, what that represents from a sales perspective. We've got a new kind of AI product launching on the same platform, the contact plates, and that will be launched kind of mid-year. That will have an increase in our recurring revenue. And I think importantly, what we're doing here is that we're not looking to apply huge amounts of costs or raise new capital to accelerate things beyond belief and have this hockey stick. We're really diligent in maintaining our cost base together with the sales growth, and we're really focused on building a sustainable, profitable company. And that will take time, but we think that's the most prudent way to go on a go-forward basis. So at that point, Mark, that's the last slide I've had. Kind of hand it over to any Q&A.
Yeah, thanks, Brent. Or Brent, sorry. We nearly up on time, but we can squeeze in a few. I might go first. In terms of, you mentioned there the new AI model coming out. In terms of R&D costs on a go-forward basis, as you mentioned in your presentation, you've a lot of money is spent in the last decade, getting to this point. But in terms of R&D for, a revamp of the machine, or, upgrades to software and the AI model and, that component of it, I mean, what does that look like on a kind of go-forward basis?
Yeah, look, we've spent, didn't have this presentation, but you're right. For over the last 10 years, we've spent about $50 million in investments in R&D on this platform technology. A lot of that's in the invention side, but secondary to that is in the validation piece. So making sure we're proving statistically through clinical studies and many customer sites that the AI platform actually works. So that's a really unique part of it. Where we're at now is a modest level of R&D. So our burn rates dropped off significantly. We're a headcount of only 19 people. And I think that's kind of an important transition that we've moved through over the 18 months. So we see, I would say, very much a stable cost base where we sit today on a go-forward basis without the need of significant new capital coming into the business to launch new products from here.
And we got two questions from the audience. One question, is this a new management team? And I can maybe answer that one myself. This is definitely not a new management team. Brent has been here for the long haul, although I would say a refresh of the board has happened since Rebecca Wilson has come in. So maybe the board is a bit newer, but I think the core management team, Brent, has been there pretty much through the
Yeah,
long haul. And then
yeah, about
a
nine
question
years for
around,
me so far.
yeah, a question just around, I mean, these Trump tariffs, and there was a big focus on healthcare over the weekend. I mean, is that impacting CapEx decisions? The question is for
Yeah.
the likes of these big guys, but I'm thinking, $1 million in terms of a CapEx decision for somebody like AstraZeneca, like doesn't even like register on their CFO's radar.
No, you're right. Look, I think it's a watching brief, like all companies, but I'll give a couple of proof points here. I mentioned at the start, if you literally do, just have a Google US pharmaceutical manufacturing investments, and you'll see multiple big pharma companies investing billions of dollars in the US right now over subsequent years. So, $1 million is a rounding error. Not saying that it's still not going to be scrutinised, but the point here is that there is significant investment going into the US from a pharmaceutical manufacturing perspective. I think the other part of that, overnight, there was, an announcement to say, well, drug prices are going to be much lower and reduced. And so what we think we'll find is that there's always going to be pressure on pharmaceutical companies maintaining quality, maintaining safety for patients, but doing it more efficiently. We think that from taking a step back, the investment proposition in a pharmaceutical manufacturing on a global basis is a very exciting place to be. We pivoted moving into this market 18 months ago. We've got a product. We're at year one of launching. So I kind of refer to us being we're at the bottom of a mountain of opportunity in front of us with a very de-risked kind of platform that already exists with some really big names already behind us. And so, it'll be a watching brief. The 10% tariff does apply. We've got an open order for AstraZeneca that's in the near term, and that's unaffected. So I think, all things at the moment would allow me to confidently say that we don't see a near-term material impact to our business. And overall, we actually see this as a very healthy and exciting sector to be in.
Okay. Brent, we're going to have to leave it there. We're just out of time, but if anybody's got any further questions, we didn't get to them all there. We had a kind of a flurry there just at the end. If you want to reach out to Brent directly, I'm sure he'll be happy to answer any further questions.
Thanks for having me, Mark. Thank you.
Thanks, Brent. And then we will move on to our second presenter. He's been waiting very patiently there in the background, Mr. Billy Tucker from Beonic. Billy, good morning.
I'm not so much patiently waiting, more listening to Brent. It was great. Great intro. Yeah, super interesting.
Billy, if you want to pull up your slide deck, I'll let you know once I can see it. Yeah, I can see the Q3 cover slide now. Billy, you can take it away whenever you're ready.
No worries. Well, thanks for having me, and thanks, folks, for joining us either live or on repeat later. I just wanted to go through a bit of a Q3 update on our business. I will spend a little bit of time introducing you to Beonic. You may not have heard of the business before. You may have heard of us as CC5. We rebranded late in 2023. I'm going to walk through our mission, our strategy, a little description on the markets that we exist within. Also, we'll open up for some questions. I think we'll have a few minutes at the end. I don't expect to take more than 15 or 20 minutes to go through this presentation. So let me just describe the mission. As I mentioned, we started life as CC5. That was really, business was born 12 or so years ago, providing ad-funded Wi-Fi services to Westfield. In fact, those Westfield malls grew to be a service that we provided around the world to 37 Westfield malls. In fact, Westfield are still a customer. And over that time, over the last 12 years, as Wi-Fi became seen as less having less utility value, the business moved into more people counting, heat mapping, and basically helping physical environments to better understand the movement of visitors, shoppers, and in the case of airports and railway stations, passengers. We've got well over 12,000 venues using our software platform in 55 countries. We've got 80 airports, including folks like JFK, Heathrow Airport, Narita, Abu Dhabi. Some of the biggest and busiest airports in the world use our platform to help them with crowd analytics and visitor insights. The core purpose of Beonic and what it helps achieve for airports, and I think this is a really interesting use case and the best way to describe the business, is that passenger numbers in airports are growing much, much more quickly than the airports themselves. In fact, over the course of a decade, we expect passenger numbers will double, and airport infrastructure grows much more modestly over that period, maybe 10 or 15%. What that means is that you've got to squeeze twice as many passengers through the same or largely the same infrastructure, which leads to one of two bad outcomes. One of those bad outcomes is that the passenger experience declines very sharply, including lateness, meaning that passengers arrive to the airport too late. They're stuck in very long queues, and over the course of that period of waiting, they miss their flight. The airlines are grumpy about that, especially in the case where bags have been loaded, and so airlines start to cancel sectors. That can be incredibly damaging for airports. The other thing that can happen is that the cost to serve the passenger goes through the roof, meaning you've got to take an increasing amount of real estate from the airport that could otherwise be used for retail and quick service restaurants and purpose that for queuing. You've got lots of staff, lots of gates, and that again becomes a very expensive exercise. Now, we know from our airport customers that to have a 10 or 15 or 20-minute queue is bad, but to have a 30-second queue is worse. Worse because the cost to serve is so high. You've deployed staff unnecessarily. It doesn't actually affect the customer experience all that much, and therefore the NPS. And so all you've done is flush money down the drain. So that's just one example of where we help airports to load balance. We do that on the left-hand side of this slide, providing crowd analytics. So we use technologies including LiDAR, radar, Doppler. They create a digital twin of a physical place, and we use that digital twin to provide predictions and alerting to the airport operator. Now, that is largely similar in a retail context, such as an intelligent mall. So a shopping mall wants to understand things like cross-shop, dwell time, how many people travel from the fashion precinct to the food precinct, and oftentimes those mall operators want to set rent using that data. Visitor insights, that's where in-store intelligence comes in. We have a lot of very large retail customers. So for instance, New Balance, 234 stores around the world, love to use our technology to help compare store by store comparison. And our technology even provides them with access to abandonment, which is very, very difficult to measure in a physical environment. But for instance, in a quick service restaurant or retailer that becomes very busy in a short period of time, we can identify customers who came in, queued, and left without buying. Very powerful. Also, with in-store intelligence, we provide those services, for instance, at David Jones in Australia, Landsec, one of the largest operators of retail property in the UK, and in many other places around the world. We offer smart city technology as well, which means in Melbourne, for instance, and in Bondi, we provide IoT infrastructure that allows the local council to identify people movement. And in fact, in the case of Bondi, we'll collect customers' first-party data and double opt-in so that they can communicate with them and give them news and updates on Bondi Beach. I want to give you a bit of an overview on our performance in Q3. Now, I've been in the job for about 18 months now, and I think in that time we've shed around $4 million worth of operating cost. And I've got to say, all in, that has been my primary goal as the CEO, is to come in and help this business to become a break-even business, meaning that we're no longer dependent on third-party capital. And over the course of the next 6 to 8 weeks before the end of the fiscal year, it's my expectation that we will achieve proper break even. In fact, if you look at Q3, we burned through about $114,000 of cash outflow from operations, but that's after paying around $320,000 of restructuring costs for our most recent round of changes that we made. We're growing quite modestly, about 6.5% against the prior comparative period, about $4.4 million worth of recurring revenue, giving us an annual recurring revenue of about 17.8, so approaching $18 million. Again, fairly modest growth, but our primary motivation over the last several months, in fact, since I joined, was to reduce the cost base, to become financially independent, to improve gross margins. And as you'll see, I'm very proud of the work that we've done to move from a gross margin of less than 70% to mid 70s. So 68.5 all the way up to 75.5% gross margin. So great outcome for the business. Been a lot of work, a ton of work for the entire company. And yet I think these results are incredibly valuable for us going forward. I mentioned specifically that we've reduced administration costs and costs relating to staff, as we described in our 4C, and I'm going to show you a little bit more detail on that later. The next phase in the organization will be that we move to a product-led growth. We have changed the operating model somewhat to move away from having a lot of boots on the ground to having folks more focused on customer success. I mentioned 12,500 venues. That is a very large customer success operation. We need to retain those customers and avoid seeing unhelpful churn offset new logo growth. So a lot of work on customer success, a lot of work on keeping customers happy. And we primarily believe that we're going to keep our customers happy and we're going to attract new customers as well as upsell from product-led growth. And so that's why we hired Mark Thompson as our Chief Technology Officer. And so Mark, along with our VP of Product, JP Talbot, have got a ton of work ahead of them to grow our organization's R&D capability and to roll out new product that our customers love. I want to mention that in the quarter, we've seen some fantastic new business sales, as well as some customers renewing. So for instance, the Hajj, which is better known as Mecca, so that's where the pilgrimage occurs every year in Saudi Arabia. So again, they've entrusted us to help them with crowd management. Powerhouse Museum here in Sydney, Adelaide Airport, Christchurch Airport, Charlotte in the US, JFK T4. JFK T6 is actually a new win for us. So it's not broadly known that airports often operate terminals separately. So we work with one terminal operator in T4. T6 is entirely separate. But because of the good work that we've done in T4 and the reputation that we've built there, we were very glad that the operators of T6 and their Securitas, their technology partner, has entrusted us with crowd management, people flow management in T6. JB Hi-Fi, tremendous win for us, their entire network, and everyone probably knows that it's one of the top retailers in Australia. So to choose Beonic's solutions, I thought was a major win for us. Heathrow Airport's renewed. MacArthur Glen is a very large outlet sales company in the UK. Chicago, Narita, and David Jones, who I mentioned earlier. We've also very importantly, I've talked in the past, and I'm going to mention in a later slide, that growth through partnerships is massively important to us. Given the number of venues that we cover, it's almost impossible for us to provide a high-touch service to those venues, and we'd much rather do it through trusted partners. And so we've done a terrific deal in the UAE with the flagship telco there, formerly known as Etisalat, now known as EAND, and it's their technology group. Now they're coming to us for our advanced Wi-Fi solutions. and they're bringing customers from day one, which is exciting for us. This is a partnership that brings revenue on day one. And that's a model that we're going to replicate elsewhere around the world. I wanted just to touch on some of the product innovation that we've rolled out in the last 3 months that's been incredibly well received by our customers. Beonic Replay, that's the ability to go back and look at specific incidents. If anyone drives an electric car, you'll often see that the way your dash cam works is you can scroll back and look at an incident and see how it occurred. Exactly the same way with Beonic's technology. If there was an unexpected congestion that wasn't predicted, for instance, by us, you can go back and replay that and just see how that emerged over time. Beonic Display, that is where we think about customer adoption of the Beonic platform kind of in 3 ways. We've got user adoption. That's where individuals, analysts, managers, etc., will use the product and depend upon the product to direct resources within an airport or even a large retail mall. So, for instance, in JFK-T4, the security team received notifications to tell them to go open a new area such that we can reduce congestion, for instance, gate A versus gate B. So we provide notifications and we help those individuals. We also have corporate adoption, which means that we issue very valuable reports, oftentimes to the board of the folks who run physical environments. And those PDFs and reports that we provide are incredibly valuable from a utilization point of view. And then lastly, we think about the adoption of our infrastructure. And the Beonic Display product is very powerful. So we will deploy screens around physical environments that provide queue time, journey times, direct mapping. In fact, in JFK, we have a project right now where we're offering screens to show when the next of these little golf carts will come along. And so JFK is a lovely airport in that they'll provide you with easy access to a cart should you not want to walk from gate to gate. And our screens provide tracking details on those carts and when you should expect them to arrive. And then the last one, I think, is probably the most exciting of all the innovation over the last few months, is our camera vision ML. We've deployed into a live environment from a US airport. We now use entirely ML to count individuals, to count dwell time, journey times, and that is working beautifully. And we're really excited to take that technology and apply it to other folks' infrastructure. The reason this one is particularly exciting for us is that the cameras that we're using there are fairly low resolution. Oftentimes, to apply an ML model, you require bang up-to-date high-resolution cameras. That's not the case here. We've actually applied our technology to existing infrastructure, and it was our goal at the beginning of the fiscal year to become increasingly hardware agnostic, and this is a massive step toward that. The ideal scenario is that we help a customer build a digital twin of a busy environment using entirely their own existing technology, existing Wi-Fi, existing cameras, existing people counters. And that way, we're simply deploying software as a layer, fully integrated and fully compatible with existing hardware. Very quick summary on our Q3 performance. I won't dwell on this, but as I say, modest growth, steady. We're reasonably happy, but more so, we were very happy to become very close to being a break-even business, and that's been our predominant focus. That bears out in our cash flow. As you can see, 114K of cash outflow from operations, including 320K of cost-cutting expenses. We have capitalized 661 of R&D costs. And in spite of, we do have uncertainty with tariffs, although yesterday's announcement seems to have given us a window to ship some product. We've got 4 large US customers who are waiting for hardware from China. We've had to put those orders on hold, and hopefully now, with this shift, we're going to be able to execute those sales, which is exciting for us. We can get it done before the end of the financial year. But we had adjusted our cost base such that it gave us a margin of safety should those tariffs continue until the end of the financial year. I've mentioned cost. a couple of times. I just want to double click on that and just show what this means in real terms. As you can see in the chart on the right-hand side, we have dramatically reduced the average compensation per employee across the business, to some extent by removing our what was a fairly large executive function in the business in favor of more folks on the ground doing the work. And we've also moved quite a few people to almost 50% of the organization is in a lower cost hub, which again has been a fantastic way for us to tap into incredible talent, high degrees of enthusiasm and energy for the business, but also a lower cost base. So as you can see on the left, almost 50% of our staff are in low-cost hubs. And on the right, as you can see, we moved from a peak of over 80% of our revenue funding labor costs to almost 50% today. Again, big moves. 105 staff down to 81 in a couple of years is a big shift for the business and speaks to the degree of automation that we're deploying. Just quickly on our strategic focus, I think I've covered a lot of this, but our purpose here is to narrow a lot of the sales focus to airports and retail, to work with global technology partners such as Salat, where we've seen great success. We've got almost 70 technology partners around the world that we work with, and over 30% of our revenue comes from those partners today. We'd like that number to be well over 50 within 18 months. Inside sales resources will help us to leverage our digital marketing base, which has become increasingly sophisticated as we've moved the entire organization to HubSpot. We previously had both HubSpot and Salesforce, and so getting out of Salesforce was really helpful for the business to simplify. Complexity doesn't scale. It's been a real phrase in the business that's used quite often as we try and find ways to simplify the company. We are looking at product feature development to help unlock opportunities to upsell to new customers and also to help win the many RFPs that we see on a monthly basis. I'm not going to go too deeply into this, only to say that first horizon was executed on track, which was a clear path to break even. Then to rebase for growth is really about product-led growth, investing in developers, and bringing Mark Thompson into the business to offer us technology leadership. Again, incredibly important. And then just quickly on Outlook, partner channels, land and expand. That was mentioned earlier. It's a truism for us. In fact, if all of our airports were to give us every one of the terminals rather than just one, we'd have an additional $20 million worth of ARR. We feel very confident that the relationship that we've built with our airport customers means that we will tap into those. They're very long sales cycles, but we will access those additional terminals, continue to invest in R&D, but also keep in mind to maintain an effective cost base, right size the organization as a whole, automate where possible. We've had years of practice with AI, and so we have AI right across the business. We need to direct it toward customer support and customer success to keep that headcount low. But we are expecting to end FY25 with an EBITDA margin of between 12 and 15%. Again, we think that is a tremendous achievement given where the business has been in the past. That was it. Thank you, Mark.
Billy, thanks very much. We've got a couple of questions coming there. I'm just going to take the first one. I mean, you touched on the AR growth being modest, and the question is, what is going to boost the sales momentum, moving forward, and where is the growth going to come from? Should we expect it to come more from airport customers, or is it going to come, do you think, more from the retail side of things?
Look, airport customers provide us with big wins that are incredibly sticky. They're typically 10-year plus relationships. So we'll see very material wins from the airport sector, but those customer. The sales cycles are long, they're hard to predict. And so my preference and our product strategy is effectively split 50-50. We've got airport product that we know helps us win RFPs when they come around. We compete incredibly well with our peers, meaning our peers are largely tied to a single technology, whereas we are hardware agnostic. And that is strategically important to us to avoid enormous CapEx investments for airports to take on our product, but also really helps with switching costs, keeping those high, meaning that if they did want to churn at some point in the future, it would require them to rip out almost all of the technology in favor of new gear. They don't want to do that. Given the large number of venues, so well over 12,000 venues on our platforms, including Wi-Fi and people counting, we have a great deal of focus on helping to take that ML camera vision model and upsell existing customers who have very basic Wi-Fi and people counting to occupancy, people movement, crowd movement, and visitor insights solutions using their existing camera tech. That's a big focus of ours. So I expect that we're going to see some material growth from those technologies being deployed to our existing customer base. That's a big focus of ours.
Another one, obviously, Mark joined the business now as CTO, new head of product sales, all of that. In terms of R&D spending, should it, have they got a bigger budget to work with like going forward? Or is it, here's what the budget is and, we got to make the best of that amount of capital that's allocated to R&D, given, we're still trying to get to proper cash flow break even on a sustainable basis, like moving forward?
Look, being a break-even business is essential. That's table stakes. That will not change. That focus will not change. We're not going to chase R&D at the expense of our profitability as a company. And with that margin of safety is vital for us. So that is my ironclad commitment, that we remain laser focused on being a break-even or better business. All that said, we believe that we've uncovered the appropriate paths to scale. Those are largely product-based, and we're making appropriate investments in R&D such that we can unlock those opportunities for us. Now, we're doing that steadily. We're not going crazy. We're not making massive investments well ahead of revenue. We believe that we can incrementally prove through proofs of concept that the assumptions we've made around areas of growth are real, and then we'll invest accordingly. But like I say, at no point do we get it over our skis and become a loss-making business in the name of R&D. This is not our plan.
Okay. And then I know you talk about operating break even. There's a question here, when do you think you're going to get to true cash flow break even, where you're covering, R&D, right, you might even call it like, true NPAT profitable, maybe, if I can say that.
Sure. Look, I'm not afraid of that. We're a little bit beholden to tariffs today. If this situation hadn't unfolded with tariffs, then I was very confident that June was a profitable month in true cash terms. I still think we'll get there in June, subject to collections being entirely on track. If you look at our P&L today, we should break even in June at a cash level, not just operating cash flow. But subject to tariffs, subject to collections, but I'm confident. So I don't want to overcommit. I think we've had a history of that in the past as a business. I want to play this with a fully straight bat, which means if we can get the product shipped that's currently subject to tariffs, and if we can get customer collections on track, we will hit cash flow break even this in June.
Okay, great. Just a question for me. It was interesting. You mentioned, New Balance are a customer. Now I'm presuming, New Balance, and I mean JB Hi-Fi, you called out as like a new win. I mean, those brands operate within Westfield malls who are already a customer as well. So is there like a kind of a crossover between, what the malls are seeing, what New Balance are seeing, and tying both of those data so that New Balance are saying we're seeing this, Westfield are seeing that, and like those two reports, I guess, kind of working together for the benefit of Westfield and for the benefit of New Balance or JB
Look,
Hi-Fi.
those. Yeah, look, there is tension that exists between those two data points. It's not in JB Hi-Fi's interest necessarily. I don't want to talk about JB Hi-Fi specifically. It's not in the retailer's interest often to share
Or
their
brands,
data
let's say, that
with.
are in Westfield. We won't mention
Yeah,
names.
yeah. So it's not typically in their interest to share with the property owner. And similarly, the property owner tends to keep precious those data points so they can use them to set rent. Where there is a large disparity between claimed growth in footfall and what, for instance, the retailer is seeing, they can absolutely use our data to help validate that is or is not true. What the mall owner might say is that the foot traffic is real and that the retailer's inability to merchandise means their share of that foot traffic is declining. But look, they don't often share, but we're happy to be on both sides of it. And what's very much true is that the technology works brilliantly, both for the mall owner and also for the retail brand owner.
Okay. Believe you've got 2 minutes. Our next presenters are just running a little bit late. I did want to just quickly go back to the airports. You were talking about they're very long lead time sale cycles, but in the case of where they are actually building new airports. So we had our Sydney conference last week, and we had the guys from Saunders in there who are building the entire refueling set up at Western Sydney Airport. They're busy in the middle of commissioning there. So, that's a new one that's coming on stream. I know in Cape Town they're building a second airport that's going to come on stream in the next 2 or 3 years. Dublin, I know from just after flying back there, it's basically at capacity. I mean, they're now running flights out of Belfast that should be going out of Dublin because they're at capacity. I mean, in terms of targeting, a brand new airport that's going to get off the ground, like let's say Western Sydney, for example, versus a one like Dublin that's like at max capacity. I mean, how does that factor into, qualifying the sales leads of, these are the airports we want to go after, and, how quickly those kind of move versus, a standard renewal at, London Heathrow, for example?
Sure. A couple of things. Beonic's technology works best for airports under pressure. If an airport is already at capacity or beyond, we can help realize significant capacity from that existing infrastructure by making accurate predictions about upcoming queue time, dwell time, passenger inbound. We take flight information data, we apply that to our existing algorithms, the real-time people count, historical people count, and then we bring all that data together to give them a pretty accurate 15-minute view on likely queue time such that they can deploy staff. If you're building an airport from scratch with 10 years worth of capacity, you may not feel that technology is as critical to you in the next 4 or 5 years. So it may not be that Beonic is an automatic choice. Now, some forward-thinking airports, for instance, JFK T6, wanted to deploy us from day one, but that's not always the case. But we definitely work best for the vast majority of airports because they're under pressure and unable to invest the capex required to just go build a brand new terminal or to expand their footprint dramatically.
Okay. So it's more, while it's nice to get in at the start and, they're like a very long relationship, it is actually probably more valuable to the guys who are like under pressure and for whatever reason, the ability to expand in the near term is limited by, government regulation
Let
or
me,
just the
yeah,
physical site. There isn't actually nowhere to expand. A whole new airport needs to be built, and some
yeah.
kind of political will needs to actually come into play, which can take years, as
I
we know in
want
Western Sydney.
Absolutely. Let me just say this one last thing. Our ability to drive yield from an airport environment comes in a couple of ways. One, happy customers with time in their hands spend more money. That money can be funneled back into an improved customer experience. Two, if we can defer the project of rebuilding or expanding an airport terminal by several years, the value of that deferral can be in the many hundreds of millions of dollars.
Okay. Billy, we'll leave it there. Thanks very much. And
Pleasure.
we'll catch up with you again, no doubt, sometime later in 2025.
Thanks.
And I am delighted to say we are now going to hand over to our final presenters of the morning. We've got Adam Bennett, CEO, on the right of your screen as you look there, and Miles Drury, CFO, on the left of your screen from Plenti. Gentlemen, morning.
Morning, Mark. How are you?
Good. After a few technical hiccups we've got there, and
Yes, we're here. We're here.
glad you've been able to make it. Adam or Miles, I'm not sure who's sharing your presentation or your Q3 update. If you want to just throw it up on screen, I'll let you know when I can see it.
We're actually just going to talk to the result.
To the Q4 result.
Oh, sorry, Q4. Sorry, I forgot you guys are on a different year end to the standard.
Yeah. So we're happy to just chat and talk through the Q4 results we've just posted.
Okay, great. I might kick off with the first question then. Adam, the last time we were on here,
why don't we take you through the result?
Do you want us to
we'll take
talk
you
you through the result, and then you
maybe throw out a few comments, and then we can jump into questions. Let's do that.
Yeah, great. Okay, so this is our Q4 results because our balance date is 31st of March. And really, it's a fantastic and balanced set of results that shows an improvement against every measure. Demonstrates that we're really making solid progress on our goal to be Australia's best lender based on speed, service, reliability, and value. And for people on the call, just to recap, we are a very kind of prime fintech lender for automotives, renewables, and personal loans. And certainly for me, the highlight is our loan origination growth. We wrote $407 million in loans during the quarter, exceeding all previous quarter records. And that was especially kind of pleasing given that Q4 is typically seasonally weaker due to the January holidays and February being a short month. So I was very pleased to see that Q4 was 42% above PCP and 6% above the prior quarter. This exceptional growth takes our loan book to $2.5 billion, which is 19% above PCP and 6% above the prior quarter. And it really demonstrates, we think, that when the business is working well with all of its elements simultaneously kind of firing on all cylinders, and that includes loan origination, fulfillment efficiency, technology, credit performance, we can really deliver profitable growth for our shareholders. And it also shows that there's significant growth potential in our core business, and that this will be complemented by a partnership with NAB during the coming financial year. As we announced to the market last September, when we launched our NAB Auto powered by Plenti product, we were very clear that volumes for Q4 would be moderate. We've seen some solid growth in March, and looking ahead, we now anticipate that NAB volumes will become a more meaningful contributor to our results. And we're quite pleased with how all of this is hanging together. So I'll add a little bit of color, and then I'll pass to Miles. So all three verticals contributed to the results. So our auto loan originations were $195 million, which is up 35% PCP, and really broadly consistent with the prior quarter, and very strong performance in a competitive market. And we've really leveraged our well-priced product and strong service proposition, and we're continuing to differentiate our offering. We also saw our Tesla subvention. We've got a great relationship with Tesla, come off slightly from the Q3 result, but we're still very pleased it contributed during the quarter, and shows that our auto offering is very competitive in terms of all of our channels to market. On the renewables front, renewables were $52 million, up 27% PCP, 6% on prior quarter. And again, the momentum in the renewables business is really strong. We build on the success of our Green Connect platform, which is a key relationship kind of differentiator with the installer base and the customers. And that's helping us drive significant growth. And we also saw more battery installations, which is great and an ongoing source of advantage for us. And lastly, personal loans. So they were 160 million, up 58% PCP. So some really big growth on prior year and on prior quarter, and extremely pleased in terms of what we're writing there in volumes and growth. And we're seeing strong demand and ongoing improvements in our proprietary tech. And also we continue to improve the customer journey and make it fast, simple, and easy. So all of that really delivered us some great volume. So I'll now pass to Miles, and he can talk to credit funding and some of the other elements.
Yeah, so just, I mean, firstly, it was a very, very strong set of results. So delighted to be presenting such strong results for the business. Credit is obviously critical for our business, and it's been one of the highlights of the FY25 year. I think in the last quarter, it continued to be really strong. We saw a result of 1.16, which was very much stable on the numbers we'd seen for the rest of the year, shows strong and balanced ongoing performance in the credit space. And we've consistently talked to the strength of the Australian consumer. The Australian consumer's been in a good place over the last little while. You saw, the tax cuts coming through the federal government, inflation starting to fall, interest rates coming down. And so all of those sort of matters coming together to put the Australian consumer in a pretty good place. And we're seeing that in the consistent and stable results that we're seeing on the credit front. Realised losses are obviously a backwards-looking metric. We do provide in the quarterly a forwards-looking metrics, which is our arrears numbers. And pleasingly, they were down at the quarter end as well, which actually seasonally is a slightly unusual trend and just talks to some really positive dynamics occurring in the credit market for consumers. Obviously, unemployment remains very, very low in Australia. Unemployment is one of the key metrics or key drivers that inputs into credit performance. And so that continued to underperform. And as Adam said, our business very much focused on the prime end of the market. And therefore, if you look across the listed sort of non-bank space, we continued to deliver losses and arrears numbers that are right at the bottom of the cohort. In relation to funding, we had a very successful fourth quarter in the funding. We came back from the Christmas break prepared to take an auto ABS to market. Market conditions were looking very strong, and so we launched that, were able to price that into early February. I'd say even there as well, probably the outcome surpassed my expectations. We saw probably some of the strongest demand we've ever seen for an ABS. We had three investors come in with bids for over $100 million of notes within sort of 24 hours of the product coming to market, which is quite unusual. That allowed us to both deliver the largest ABS we've done at $509 million, but also continue to tighten up that pricing and bring it into pretty attractive levels relative to history and relative to the end of the year. Obviously, there have been some ups and downs in capital markets the last few months with what's been going on in the US, although I guess as of last night, that's all off again. I guess one good thing, though, is that even despite that volatility, we saw one of our peers price a very successful $1 billion ABS placement just last week, a couple of others in the market going well. And so it just continues to show that investor demand for Australian securitized credit is very strong. I'll let Adam wrap up with the cash NPAT numbers, but again, I guess as CFO to deliver such strong cash NPAT numbers, I'm delighted to see that.
Yeah, and thank you, Miles, and bring it all together. So really strong growth in originations, as I mentioned, and all elements of the business are going well in terms of our cost discipline, our credit, our funding decisions, etc. And so when all of that comes together, the machine that's been designed works and throws off some good cash NPAT numbers. So as people may recall, we delivered $5.5 million of cash NPAT in the first half of FY25. And we've built on that with some good growth into the second half, where we delivered $8.3 million of cash NPAT. So full year result is $13.8 million cash NPAT, which represents growth of 126% on the prior year's number, and really shows that we're starting to produce substantial profitability. So we're delighted with that, and really just shows that when everything simultaneously works, we get really good results. So at the start of FY25, we also set ourselves three clear financial objectives for the business. That was 1, grow loan originations and loan portfolio; 2, continue our profitability momentum and drive year-on-year and half-on-half cash NPAT growth; and 3, continue to improve cost efficiency. So we're really pleased that we can tick off all three of those, and we're in really good shape as we enter the end of the month, and we deliver our full year result on 21st of May. So might pause there, Mark, and take any questions.
Yeah, obviously another very strong result, as Miles said, and I just want to touch, with that, strong cash impact, you know, I mean, capital allocation options start to open up in terms of, you know, maybe a dividend coming at the full year, reinvesting back into the business, whether that's from, a CapEx point of view in terms of, further upgrading the platform, or, other kind of initiatives. I know the NAB initiative is a big initiative, but maybe just talk to, where all of this cash is going to be are going to be allocated across the business. I don't know, Adam or Miles, or maybe
It's
both of you
probably
want to take
one
that one.
probably one for me. And yes, and obviously we'll provide more information on cash flow with our full year results in a couple of weeks' time. But as that cash NPAT number starts to step up, yes, there's obviously a correlation pretty clearly with operating cash generation of the business, and it was nice to see a pretty substantial operating cash generation. Being a financial services business, we do invest capital as the business grows to support our securitized funding structures, and that's definitely our first priority. Growth. It's been great to see the business accelerate its growth. In Q3 was a record originations. Q4 has been a record originations. So we're accelerating growth in our loan book. But absolutely, the first place that we're looking to be deploying our capital, given the types of returns that we get on it, is actually into supporting growth. And obviously, our intention and objective here is to continue to see how far we can push, because ultimately, financial services businesses, and you see it in the way our cash NPAT has stepped up and accelerated ahead of loan book growth. The secret that we need to, or the thing we need to deliver here, is continued loan book growth. And so that is the primary objective for us, and where in the first instance we'll be deploying the cash that we generate in the business.
Yeah. And maybe, Miles, if I stick with you, maybe another question, just when you did touch on, the ABS funding that was done, and it sounds like you've been able to tighten up spreads as the book has got bigger, and obviously the track record is starting to get further enhanced. If we look out over the next 12 or 18 months, does the funding mix start to change, and can you get does that mean the spreads even come down even tighter, and you get even better pricing, or what are you looking at, if we look out like 12 months from a broader funding perspective, whether that's mix, spreads you'd like to see getting in, given the results that you're posting probably forces the hand of the lenders to say, well, actually, guys, that was where we were 3 years ago. We're at a different place now, and you're going to have to come to the party.
Yes, look, we're always looking for ways to make our cost of funds more efficient, but probably the key thing that it's in my mind is probably twofold. One is just continue to expand that investor base who supports the business, and that's particularly as we do ABS deals. A lot of our investors who support those deals are offshore, be that out of Asia, be that out of Europe, and lesser extent, and that this is across the Australian market, out of the US as well. What has been good, and you alluded to it, Mark, as the business has become more established, we've grown in scale. We've now done 8 ABS deals over $3.4 billion of funding. We're a pretty well-known quantity in the market, and we've delivered a track record. People can see how our deals perform. In the last 12 months, we've called our first 2 deals. So we've completed the entire life cycle of an ABS deal, and that just builds investor support. And there's no doubt that getting the last couple of deals done has been easier, and market conditions were very favorable. But even with that, it's got easier because investors know who we are. And so, again, back to that objective around scaling the business, growing it. What I want to make sure, and the first and foremost, is that as we add more to the size of the loan book, we've got really strong support, that we're flexible and diverse funding. So if there are any hiccups in markets, we've got lots of ways to deal with that. So yes, we want to keep driving price down, but I think it's just continuing to broaden out that investor base to make it more stable.
Yeah. And Adam, the last time we were chatting, you said a big focus was on kind of cross sell across the 3 divisions, because we were talking a lot about on the AHO side, a lot of stuff around like EVs and hybrids, but also the home battery space, and maybe there was customers there that you could kind of cross between the two, and it hadn't really been a focus kind of previously. So maybe just talk, you've kind of been in the hot seat a few more months now, how that cross sell across maybe Ao's personal and renewables is kind of starting to weave its way through the sales channels.
Yeah, really good question, Mark. And look, it's fair to say that for all financial services, kind of cross-sell and extending lending from existing customers is or should always be a priority. And I don't think we're any different in terms of that. And it's a natural desire. You put new loans in the top, and then obviously they get paid back over time, which is great. And but it means the amortization out the bottom of the loan book has to be dealt with. So we are now at a size where that makes a lot of economic sense for us to focus on that. Our loan book growth has grown very rapidly, and we do have a back book of customers now that we are starting to look at closely and make sure we can build deeper relationships with them and offer them new lending to match their life goals and life dreams, and that's what it's all about. And so we are putting some effort into that. We'd like to do build on the work that we've done, and we're starting to see really good results. And we'll talk a little bit more about that and our future outlook at that for at our full year results.
But definitely, I mean, we deployed some new technology into less cross-sell and more relend over the last 3 to 6 months. And one of the contributors to the strong performance in Q4 was starting to see that tick up. We've still got a long way to go. We've still got more we want to do. But yes, continue to enhance the technology, which we did in the quarter, was a contributor. And that technology improvement is, you can see it in the uptick in relend in our business.
Yeah, which is really pleasing.
Yeah. And I mean, renewables, I know it's coming kind of off a bit of a lower base, but I mean, that was kind of maybe the standout division in terms of percentage growth or whatever. I mean, what is driving that? I mean, is it, cost of living pressures, and, people are like still, trying to, they're willing to take on the debt to kind of get the monthly utility bills down, or, just is it coming from, it's now standard in new builds and renos, and you're just kind of riding that tailwind of, this is how, the new modern home is being constructed, or the new modern home is being renovated. If you're buying a 1970s house, and there's a big reno going to happen before you actually move in.
Yeah, look, Mark, I mean, you've named all of the drivers there. I mean, I think it's a combination of multiple things. So obviously, building codes and requirements for people to have kind of green energy and green homes, etc., I think is going to increase, and we are seeing that as a driver. We're also seeing people make commercial and economic decisions around setting up, their solar panels to reduce their utilities costs. We're also seeing now increased take-up of batteries and the creation of virtual power plants, which then helps people export that energy back into the grid, which is great for all of us in terms of maintenance of capacity for electricity and those types of things. And of course, we're also seeing government incentives for people to do this as well, which is great. And I think lastly, we're also seeing people kind of push into this space because they believe it's the right thing to do from a climate perspective, and they want to kind of contribute and make a difference to the welfare of the planet, which I think is great. And that's something that I'm certainly proud of, that Plenti plays a role in helping people solve their utilities and do something with their solar panels and batteries. So it's a combination of all those things, and we're seeing a lot of growth, which is great.
And I think the only thing I'd add to that is also execution by our team. So the market is growing through demand, as Adam said, but our team's executing very well. Again, there's a differentiated technology platform that they utilize there to help them to gain market share. And so it's also our execution and taking market share that's been driving that growth.
Okay. You mentioned some of the government incentives and stuff on the renewable side, and home energy, green energy space. Obviously, we just had the election. Labour are coming back in, so we don't have a change of government. And in a business like Plenti, we always say, regulation is not far away from a business like this. In terms of, you know, prior Labour policies that are, going to be kind of implemented or continue to be implemented as part of the next administration, or things that are coming out from APRA miles that we, maybe need to keep an eye on. Is there anything in the next, 12 to 18 months that, the sector as a whole, should be aware of, or investors need to be cognizant of, on the positive side or the negative side?
Yeah, I think there are a couple of things coming down the pipe. Some positive, one existing that we'd hoped would go away, but it won't. On the positive side, obviously the Labor government does have a commitment to a national battery subsidy, and that should be beneficial for demand for batteries, which is beneficial for activity. It probably brings average loan sizes down a little bit, but I think it encourages more people to get into that space, which is a good thing for us. So that's definitely a positive. This has been on the cards for a while, and I don't think the change of government changes, but there is BNPL regulation coming in, and in our renewable energy product, it is currently funded under the BNPL code. That'll require some changes from us as to how we operate that product. But I think actually net, we probably see it as a positive. I think being an entirely compliant lender across a whole lot of other areas where we operate, within the credit code, means we're further ahead than maybe some of our competitors are on that. So there's a bit of work for us to do, but we think net it's probably a positive. The one item that's has been a bit of a frustration, we probably talked about this before, is the FBT benefit for electric vehicles does push EV borrowers towards a novated lease structure. And it does feel that with the Labor government being returned, that's less likely to change, at least in the near term. And so it doesn't necessarily take away from our business, but it maybe some of the growth we might have chased had that policy been changed is a bit harder to access than it might have been if there'd been a change of government.
Yeah, and then there's some early kind of indications from the Labor federal government also on removal of luxury car tax. So again, that's a positive in terms of building demand. And also the West Australian government, the federal government, as Miles mentioned, is putting EV incentives in place and battery incentives in place. And so is the West Australian government at the moment. So they're looking at another scheme as well. So we believe there will be strong kind of government policy impetus in the market, and that will continue.
Yeah. And then just on the AHO side, we saw, as a result of COVID, when you break logistics change or mess up manufacturing workflows, the time to resolve those can really drag on. I know my brother was trying to buy a Toyota RAV4, one of the hybrid ones, and I think he waited 14 months.
Hopefully you need to loan and you can send him our way.
Yeah, I think he waited 14 months to get it in the end. Just with all this tariff impacts, I guess, you would think it wouldn't impact a business like Plenti, but on the AHO side, has it been any feedback that it's affecting manufacturing output from China or Japan, or they're reallocating this, that, and the other? It's kind of these second and third order effects that we don't think of, because obviously if you haven't got the stock, you can't sell it.
Yeah.
Then the financing can't
Yeah,
go.
look, certainly we're not seeing any sign of that. We know that Tesla, for example, is starting to land more of their new Model Ys, which is great. There's different schools of thought in terms of some of the supply chain kind of impacts from China and Japan, etc., where less cars, or demand in the US. Is that going to translate to they start to pick that up or send that somewhere else? So I really think market's too early to tell. Certainly in terms of what we're seeing strong demand. We, as you saw in our Q3, which was a record, Q4 was a record, which took us through till March. And so, we're quite pleased with the volumes and the demand that we're seeing.
And we're much more a market share game. If market goes up 5%, down 5% because of cars coming in around, it isn't really the issue for us. Our question is, can we go from a 3 or 4 market % share to 5 or 6? That is
our question.
That's huge growth. 5% up or down in the market is in some ways neither here nor there in the scale of the business. So that's what we're again focused on is how do we continue to deliver the best product, the best experience, the best technology solution for customers so that they choose us, and that helps us grow our market share.
Well, on growing market share leads on nicely to my next question, the NAB partnership. We're a bit further down the track than the last time we spoke. I think we had you guys on maybe I think the end of January, early February. Still very early doors, and a lot of integration work I think is still happening in the background there, especially on I think from NAB's perspective. Maybe just a quick update or a quick comment on that, and in terms of how the rollout is going to go. I know, Adam, the last time you said it's at least going to be 18 months before this really starts to get proper traction and kind of
Yeah,
really kind of show up in the numbers.
Yeah, what we said back in September. So it launched on the 23rd of September last year to NAB customers. So we were very careful, Miles and I, at our quarterly results then, to be clear that we knew there would be moderate volumes over the next 6 months as we just worked with NAB to bed it all down and really get it integrated into NAB's systems, etc. That work is now done, and so it is now visible on NAB's systems. And as you imagine, an organisation the size of NAB, so that means their website, their internet banking app, etc. They're starting to invest in external advertising. They're starting to kind of really look through the lens of how they're pricing the product, and we're really pleased that we've spent that 6 months really bedding it down. And so, as I mentioned in my opening remarks, we're now confident it will become a more meaningful part of our results as we go forward into the new financial year.
Yeah, so I mean, it was still low numbers, but the fact that it was 3 times up in the quarter on the prior quarter, sort of March was a 60% growth on the prior month. So again, it's coming off a low base, but with all of that technology setup work done, we're starting to see some momentum. And so again, we've just got to be head down, work really hard with NAB to keep on driving and delivering good results there, and we'll update on at the quarter.
Okay, perfect. Gentlemen, I think we're just bang up on time there, and I know you guys have probably got a busy day, so I don't want to chew into your work day too much. But thanks very much for joining us. And Miles, just remind us there the exact date that the full year results come out, so I can mark in the calendar.
Full year results will be out next Wednesday, the 21st.
The 21st. Okay, perfect.
May, yeah.
Okay, we look out for that, and there'll be a bit more detail in there. But I think we've definitely hit a lot of the highlights here this morning. And thanks very much for coming back in and joining us once again.
Thanks, Mark.
Thank you very much.
And thank you for everyone dialed on. Thank you.
Thanks, Adam. Thanks, Miles. And with that, we'll end this morning's meeting. And everybody have a good rest of their Tuesday. Thank you.